Howdy, Jacob here. Today we're looking at company 84 in our dividend yield screener, Kinder Morgan. Let's look at some financials here. So it's in the oil, gas, consumable fuels industry, $40 billion market cap with a $67 billion enterprise value. So that's looking about 28 billion net debt. Dividend yield is 6.3%. Let's look at that debt in comparison to cash flow. So 32 billion in 2012 down to 28.4 billion. It got as high as 42 billion in 2015, but looks like they've consistently bought down debt. Let's see. Yeah, consistently bought down debt. Their free cash flow 5-year average, let's say 4 billion on a $28 billion long-term debt. You're looking at seven times 5-year average free cash flow. So it's more than what you'd want, but it is promising to see that they've been paying down that debt a little bit at a time. That's the thing. A lot of these dividend stocks have a lot of debt, it appears, and even if you're like this company right here, paying down debt, 500 million at a time, that's not going to do too much damage on $28 billion. And I mean, if the lenders come, the company could go out of business if they can't pay it back. But the first thing that they would do as a lender is say, hey, we want this money now, and the fastest way to do that is or we want it over the next 3 years. The company's going to have to cut the dividend to do such a thing, and they don't have a lot of cash on hand to really help out with that. But if we just look at the payout ratio itself, 2.5 billion on, let's say, 4 billion, like we said before, on the free cash flow side, we're looking at a little over 60% payout, which is a good amount, but not unheard of for a company in the oil and gas business where they might not have the most opportunities for growth. But it looks like they've been increasing the dividend. I guess their payout. They've been increasing their payout. Um, what about shares? What are we looking at? 1 billion. And then there must have been acquisition 2014, 2015. Let's see. I don't know really. I don't know how they just issued a bunch of shares and preferred stock. Okay. Okay. So interesting, but looks like since then 2.18 to 2.26 billion. That's not too much issuance of shares. So let's start to set some assumptions here. If we look at the dividend, like I said, about a little over 60% payout. I think for now I'm fine saying that that's reasonable. Let's say they pay out 60% in the dividend, maybe the 10% acquisition reinvestment, 30% to paying down that debt. As long as the lenders are fine with the amount of as long as the lenders are fine lending to them with these current numbers, should be fine. But let's look at some revenue growth here. 14 billion to 19 billion in the oil and gas business. I'm going to assume zero growth. 10 for P, price free cash flow, 15% return. Margins average 9, and then way higher free cash flow. That's cool. Definitely like to see a higher free cash flow margin than earnings margin. Maybe 16, 0%. So with these current assumptions, we're saying that the stock would have to fall 54% to get to a price that's going to give us a 15% return. I think for now, there is a good amount of debt for the company, but it is promising to see that at least they're starting to pay it down a little bit, and the payout ratio is 60%, a little over 60%. Honestly, not that's not horrendous for a business that doesn't have a whole lot of growth potential ahead of them. So I think that dividend might hold as long as the lenders are good with that, as long as they're able to refinance with everything they have right now. But for now, As for the company, I'm just waiting to do more research on it. It's going to have to fall quite a bit more. Thank you and have a good rest of your day.